Should we do it? I mean, it's so simple, right? It's just whoosh, whoosh, open, close, open, close, open, whoosh. Hey folks, and welcome back to the channel. For those of you that are new, my name is John, and this is a channel I dedicate to bringing you all of life's tips, tricks, hacks, cheat codes. You name it, I probably have it. Now, it's been a little bit over a year since I've started my YouTube channel, and I don't think I've actually told you who exactly I am and how I got here. I got here through a bit of a non-traditional background. In college, I studied biology and psychology, and then I went on to pharmacy school. After pharmacy school, I went on to work for a very large pharma company, after which I went on to work for a very large tech company. Now, all the while, as I still currently work in tech, I manage my social media channels at John's Finance Tips on TikTok and Instagram, as well as on YouTube. Now, my mission, very straightforward. You don't need a finance degree or any training in finance to know and understand how finance can work for you. Because at the end of the day, personal finance, it's personal. Anyway, I'm gonna stop blabbing because you probably clicked on this video for one reason. You're considering, should you or should you not cancel a credit card? Well, I'm here to convince you that absolutely you should cancel your credit card. And if you don't believe me, keep watching. Okay, before we start talking about canceling cards, we need to address something very important, and that is, what exactly is a credit score? Likely, the reason that someone told you not to cancel a credit card is because it'll hurt your credit score. So that begs the question, what is a credit score, and why is everyone so uptight on having a high number? So the way that I like to describe a credit score to my friends, and the way that is easiest to understand, is think of it as an analogy to a GPA or grade point average. Let's be honest, we've all been through school, we've all taken quizzes and tests and exams, and sometimes we do really, really well. And sometimes, if you're like me, we don't do so hot. But we know it doesn't matter because at the end of that school year or at the end of the semester, it all gets averaged together and you get a final grade point average. And that grade point average paints a much more holistic picture of that student's general aptitude and understanding of the class, of the subject, and so forth. But each individual exam, it doesn't do as great of a job. A credit score is very similar in that regard, in that it's all about the average. So a credit score is an indication of a consumer's behavior and ability to manage debt. And similar to how having a high GPA could mean on paper you're a good student, having a high credit score means that you have a very high credit worthiness and credit trust. So what exactly then is a credit score composed of? Well, there are 5 key components within the FICO 8 credit score scoring model. I'm gonna go in order of most important to least important. So the very first one is on-time payments. This accounts for 35% of your credit score. And as the name would state, it's as simple as that, make payments on time. Now, if you're just late by a day or 2, or even up to 29, it's not a big deal and it's not gonna negatively impact your credit score. I'm not saying you should do it, but don't freak out if it's a couple days late. However, at day 30, that is a big deal. So whatever you can do, set reminders, make it automated, but make sure you are paying your credit card bill on time. The second component is credit utilization, and this accounts for 30% of your credit score. Check out this example to explain exactly how credit utilization works. So I've got here with me 2 credit cards. I know technically this is a charge card, but just pretend, 2 credit cards. And we're gonna say each card has a $5,000 limit. So in aggregate, I have $10,000 of total available credit to make. Now, I go ahead and purchase, let's say, a camera lens. This camera lens, let's just say, was $2,000. A $2,000 charge against a total credit limit of $10,000, I am utilizing 20% of my total available credit, or we can say another way, 20% utilization. This, it's not bad actually. I would say 20% or lower is good. It's basically showing that you're not using all of your available credit, and therefore that's positive. If you go over 20%, that could be seen as a net negative. But in this example, $2,000 charge, $10,000 total aggregate credit limit, 20% total utilization, we're in the clear. The general rule of thumb I like to tell folks is try to keep your utilization 20% or below, ideally below. The next component is average age of your credit history, and that accounts for 15% of your total score. The average age of history is quite simply taking how long you've had cards in aggregate, how many cards, and its division. The next component that accounts for 10% is hard inquiries. Basically, anytime you apply for any sort of loan product and they pull your credit report, that is an inquiry. And the last component also accounts for 10% is your different types of credit mixes. So for example, credit cards are a revolving type of loan, whereas student loans and mortgages are installment-based loans. Lenders just like to see a variety. However, if you think about all 5 components I talked about, the first 2, on-time payments and credit utilization, account for 65% of your score. That is the most important in my eyes. So when it comes to how do I focus on improving my credit score, those are the key components I always look to first. Cool, so I feel like now that we've laid the stage of what exactly a credit score is, now let's talk about what happens when you cancel a credit card. Well, first, here's what you probably think happens when you cancel a credit card. You think when you cancel a credit card, immediately that average age is gone from your report. Poof, gone. You think if you had a card open for 10 years, that 10-year history, poof, gone. However, what actually happens, as long as that card is closed in positive good standing, meaning the balance is paid off in full, it will continue to sit on your credit report and provide you the positive boost from that average age for another 10 years. Let me say that again. When you close a credit card that is in good standing, it sits on your credit report for 10 more years, giving you the positive boost of that average age. It doesn't just poof, gone. I know, that kind of goes against what most people think. Most people think if I close it, it's gone. But that's not the case at all. However, if you close it in negative standing, that will also haunt you for 7 years. So make sure if you're gonna close it, pay it off in full. Don't just stop paying and charge it off. So as you can see, closing a credit card doesn't net negatively impact your average age of credit history, which accounts for 15% of your credit score. So if it doesn't negatively impact that, then John, why is it that when I closed my card, my score dipped? Very good question. And to answer that question, let's go back and review the 5 key components of a credit score: on-time payments, credit utilization, average age of credit history, your credit mix, and your hard inquiries. Now, when you close a card, most people think that it impacts average age of history. It doesn't, like I just told you. However, what it can impact is your credit utilization. I have here again my 2 cards, $10,000 of a credit limit. I have here again that camera lens, which costs $2,000. This is a credit utilization of 20%. 2,000 over 10,000, 20%. However, if you decided that you were gonna close one of these cards, let's just pull away this card right here, a $5,000 credit limit, $2,000 charge, that would be a 40% utilization. You will get hammered for a 40% utilization. Remember, credit utilization accounts for 30% of your total credit score. And when you have a utilization at 40%, that will negatively impact you. So you're probably wondering, well, how do I get around it? To get around it, if you had higher overall credit available to you, let's assume for just a second here that instead of having $5,000 of a credit limit each on this card with $10,000 in aggregate, let's assume you had $10,000 credit limit on this card and $10,000 credit limit on this card. So in aggregate, you have a $20,000 credit limit, $2,000 charge, 2,000 over 20, that's a 10% utilization. If you close one of these cards, 2,000 over 10,000, that's gonna be a 20% utilization, you're in the clear. See, that is why your credit score could be negatively impacted if you close a card. However, if you have high available credit, there should be no negative impact. Trust me, I know that everything I just told you probably flies in the face of what you assumed and thought. And part of my core messaging always is, let's go ahead and challenge that status quo, right? Let's dig into the exact whys of closing a credit card could be bad for you. So, as you can see, it has nothing to do with the average age because it continues to age on the credit report. It has entirely to do with your credit utilization, but if you have total high available credit, you're good to go. And here's some other examples of why folks would want to close cards. For me, the biggest one is if you have a lot of number of cards. I mean, at one point I had amassed over 1 million points within 1 year. I had a lot of credit cards. That is a lot to manage, and there are always gonna be potential fraud and security risks when you have 10, 15, 20 credit cards. And so typically for me, after about 12 months, I'll go ahead and close cards that I am receiving no benefit from. Another reason you might be looking to close cards, reduced credit limit. I know that kind of flies in the face of what I said earlier. You want to maintain a high credit limit, but sometimes when your credit limit is so high, certain banks won't approve you. Case in point, Chase Bank. Chase Bank will not approve you for more credit if the available credit that you have is 50% or greater than your stated income. For example, if you have $100,000 of stated income and you have $50,000 of credit limit from Chase, they will not approve you for another card, period. They're like, why would we give you more credit? To get around it, you would have to either close a card or reduce the credit limit. So that is another example of why folks will want to close their credit cards. And the third reason I see folks wanting to close credit cards has to do with bonuses. If you are looking for another sign-up bonus, but in the terms and conditions it says you cannot currently have this card, then you're gonna have to go ahead and close that card. And now you know you can do it safely without negatively impacting your credit score as long as you have a high amount of credit available. All right, folks. This has been an incredible video. I hope you took some notes, took some value out of it. For whatever the case may be, if there are questions, please drop them in the comment section below. Again, my name is John of John's Finance Tips, and I will catch y'all next time. Peace!